Why 2026 could destroy more wealth than the Great Depression. You've heard the saying, history doesn't just rhyme, it repeats. Well, the Great Depression wasn't some random out-of-the-blue disaster. It was the predictable final act of a four-part play. Today, that same pattern isn't just re-emerging. We are already deep into its final phase. A 2026 financial reset is no longer a fringe forecast. The stage is set for a crisis of historic proportions. What if you lost everything you've worked for? Imagine your stocks vaporized, your home's value plummeting, and your savings inflated into worthlessness in a financial collapse that could dwarf the 1930s. The Great Depression saw the stock market fall by nearly 90% and the entire U.S. economy shrink by a staggering 30%. Today, we aren't just looking at a repeat. We are staring down the barrel of a crisis that could be magnitudes worse. This isn't about fear-mongering. It's an alert based on historical cycles and the blinking red indicators that are firing right now. In this report, I'm not only going to prove it to you with historical data, but I'll also show you exactly how the playbook for this reset is written and how you can use it to protect everything you have. Your financial future truly depends on understanding what's coming. The unbreakable pattern of crisis. Every major financial crisis in modern history, without exception, has followed a powerful sequence. It's a four-stage cycle of debt that has the cold, hard logic of mathematics. This isn't just a theory, it is pattern recognition from centuries of data. The stages are foundation, expansion, trigger, and destruction. Understanding this pattern is the key to seeing why 2026 isn't just another year of market ups and downs, but the scheduled end of an era. Stage 1 is the foundation. This is a period of healthy, productive growth. Debt is used for good reason, building factories, developing infrastructure, and funding businesses that create real value. During this stage, debt actually serves the real economy. Growth is real, and people are optimistic for a reason. Think of the industrial expansion that powered the early 20th century. Stage 2 is the expansion. This is where things start to get dangerous. Credit begins to grow much faster than the real economy. Lenders, chasing fees, start to relax their standards. Speculation becomes the name of the game. Asset prices, stocks, real estate begin to inflate, not because of their real worth, but because a flood of easy money is chasing them higher. People borrow against these inflated assets to borrow even more, creating a toxic feedback loop. The entire system gets hooked on the expansion. Banks need the fees, pension funds need higher returns, and governments get addicted to the tax revenues from a booming yet hollow economy. This is the stage of collective delusion where everyone thinks the party will last forever. Stage 3 is the trigger. The system has become so fragile, so over-leveraged, that even a small shock can set off a catastrophic chain reaction. It could be an interest rate hike, a big company going bankrupt, or a geopolitical event. This trigger causes a predictable domino effect. A few defaults spark panic, lenders demand their money back, and borrowers are forced to sell assets to pay their debts. This forced selling pushes asset prices down, which shrinks the value of the collateral backing all the other loans in the system. This is the start of the deleveraging spiral. Liquidity, the lifeblood of the market, dries up almost overnight. Stage 4 is destruction. This is the financial reset. The immense paper wealth created during the expansion phase gets annihilated through a brutal mix of mass defaults and currency-destroying inflation. The middle class gets eviscerated. Their savings are wiped out, their homes lose value, and their jobs disappear as the economy shrinks with terrifying speed. During this phase, hard assets aren't destroyed. They are simply transferred. Wealth moves into the hands of the few who were prepared, those who held real value instead of paper promises. This four-stage sequence is the rule book. It played out in Weimar Germany in the 1920s, it hit Japan in the 1990s, and its most infamous example, the one that set the benchmark for financial horror, was the Great Depression. Historical proof, the Great Depression decoded. To understand what's coming, we have to look back at the most devastating economic collapse of the modern era. The Great Depression of the 1930s wasn't a black swan event. It was a perfect textbook execution of the four-stage debt cycle. Stage 1, the foundation, was the Roaring '20s. After World War I, the United States saw incredible industrial growth and innovation. Production soared, and a true consumer culture emerged for the first time. This was a period of legitimate economic expansion. But this bled into Stage 2, the expansion, where financial speculation began to overshadow real growth. By the late 1920s, the stock market had become a national obsession. The critical mistake was the explosion of margin debt. Everyday people were encouraged to borrow huge sums to buy stocks, with the stocks themselves as collateral. In the 1920s, a buyer might only have to put down 10–20% of their own money, borrowing the other 80–90% from a broker. As stock prices soared, people could borrow even more. The market was floating on a sea of leverage. The Shiller P/E ratio, a measure of stock market valuation, peaked around 32, a level of extreme overvaluation. Yet, on the surface, everything looked perfect. Just before the 1929 crash, the U.S. unemployment rate was a tiny 3.2%. The economy, everyone was told, had reached a permanently high plateau. Then came Stage 3, the trigger. On October 24, 1929, Black Thursday, the market wobbled. This slight dip was all it took. Brokers who had lent out billions for stock purchases made margin calls, demanding their clients put up more cash. But the cash wasn't there. People had to sell stocks to meet the calls, but their selling only pushed prices lower, triggering even more margin calls. It was a catastrophic, self-reinforcing spiral. This led directly to Stage 4, the destruction. The stock market crash was just the beginning. The Dow Jones Industrial Average ultimately fell by a staggering 89% from its peak. The financial carnage spread to the real economy like a plague. As savings were wiped out, consumer spending evaporated. Businesses failed, and unemployment skyrocketed to a peak of 24.9% in 1933. The nation's gross domestic product collapsed by nearly 30%. The banking system, which had fueled the mania, disintegrated. A panic of bank runs led to waves of failures, and over the course of the 1930s, more than 9,000 U.S. banks failed, taking the life savings of millions with them. It was a complete and total reset of the financial system. The pattern repeats: Weimar and Japan. Lest you think the Great Depression was a uniquely American disaster, this four-stage pattern is a global phenomenon. It has repeated itself with frightening precision across different cultures and eras. Look at the Weimar Republic in Germany in the early 1920s. After World War I, Stage 1, Germany was crushed by impossible war reparations. The government, rather than default, chose to print money. Stage 2. At first, it seemed to work, but as the currency lost value, they had to print faster and faster. The trigger, Stage 3, was the occupation of the industrial Ruhr Valley, which crippled Germany's ability to produce real goods. The government's only response was to fire up the printing presses with a fury never seen before. This ignited Stage 4, destruction, in the form of hyperinflation. The German mark became worthless. Prices doubled every few days. A loaf of bread that cost 160 marks in 1922 cost 200 billion marks by late 1923. Life savings were used as kindling for fires. The middle class was erased, paving the way for the political extremism that followed. Now fast forward to Japan in the 1980s. After its post-war economic miracle, Stage 1, Japan dove headfirst into a speculative frenzy, Stage 2. Easy credit fueled an immense bubble in both its stock market and real estate. At its peak in 1989, the land under the Imperial Palace in Tokyo was supposedly worth more than all the real estate in California. The Nikkei stock index quadrupled, and price-to-earnings ratios soared to around 70, far beyond the insanity of the 1929 U.S. peak. The trigger, Stage 3, came when the Bank of Japan, terrified of the out-of-control bubble, decided to hike interest rates. The cheap money fueling the mania vanished. The result was Stage 4, destruction. The Nikkei stock market crashed, eventually losing over 80% of its value. Real estate prices collapsed. Japan fell into a period of economic stagnation known as the Lost Decades, from which it has arguably never fully recovered. The lesson from these events is brutal and clear. The cycle is powerful. The details change, but the math of an unsustainable debt binge always leads to the same place. The belief that this time is different is always the most expensive lie in finance. The final phase, why 2026 is Stage 4. To where are we now? The frightening reality is that the United States and the entire global financial system is a perfect mirror of these historical precedents, but on a scale that is almost impossible to comprehend. We have completed Stages 1 and 2, and the triggers of Stage 3 are now activating one by one. Stage 1, the productive post-war boom, arguably ended in 1971 when the U.S. decoupled the dollar from gold. This event marked the beginning of Stage 2, a 5-decade-long supercycle of debt expansion. Since then, U.S. total debt has multiplied exponentially. Today, the numbers are catastrophic. The U.S. national debt is over $38 trillion. Household debt is over $18 trillion. When you add corporate and financial debt, the total credit market debt in the United States is now over $100 trillion. Worse, nearly every asset class is in a synchronized bubble. The Shiller P/E ratio for stocks, a key indicator of market valuation, is currently hovering around 40, a level only surpassed at the absolute peak of the dot-com bubble. Housing prices relative to income are at all-time highs. Bonds, real estate, stocks, everything is overvalued all at the same time. This is the everything bubble. Now the Stage 3 triggers are flashing red. Trigger 1, Federal Reserve rate hikes. Just like the Bank of Japan in 1989, the Fed aggressively hiked interest rates from near zero to over 5% to fight inflation. This has a delayed but lethal effect. The annual interest payment on the U.S. national debt alone is now rocketing toward $1 trillion. More acutely, it has detonated a time bomb in the commercial real estate market, where over $1.5 trillion in loans need to be refinanced in the next few years at much higher rates. Trigger 2, the reverse repo facility drain. The Fed's reverse repo RRP facility, where money market funds could park excess cash, once held over $2 trillion. Now, that facility has been almost completely drained to just a few $billion as of early 2026. This means all that excess liquidity has been pumped back into the market, providing one last artificial boost. With that fuel gone, the system is running on fumes. Trigger 3, the yen carry trade unwind. For years, investors borrowed Japanese yen at 0% interest to buy higher-yielding U.S. assets. As Japan is now being forced to raise its own interest rates, this trade is reversing. Potentially over $1 trillion could flow out of U.S. assets and back to Japan, forcing the sale of U.S. stocks and bonds. Trigger 4, China dumping U.S. treasuries. China has been steadily selling its holdings of U.S. debt, reducing its position from a peak of over $1.3 trillion to around $700 billion or less. As geopolitical tensions rise, this trend could accelerate, putting immense upward pressure on U.S. interest rates at the worst possible time. Trigger 5. Regional bank stress. Just like the smaller banks in the 1930s, today's regional banks are sitting on massive unrealized losses on their bond portfolios thanks to the Fed's rate hikes. They are also heavily exposed to the struggling commercial real estate market. The failure of a few of these banks could easily trigger a loss of confidence and a contagion of bank runs, just as it did in 1930. Those aren't isolated problems. They are interconnected fuses leading to the same powder keg. When these triggers converge, it will ignite stage 4 destruction. A significant fall in stocks and real estate from these bubble levels could erase tens of trillions of dollars in paper wealth, an event that could make the Great Depression look small by comparison. The pivot to opportunity. This information isn't meant to paralyze you with fear. It's meant to arm you with the truth. Because a crisis of this magnitude isn't just a period of destruction, it's also the single greatest wealth transfer in world history. A famous banking proverb says that crashes don't destroy wealth, they simply redistribute it. During the Great Depression, while millions lost everything, a prepared few, like Joseph Kennedy, understood the cycle. They not only preserved their capital, but built dynastic fortunes by buying assets for pennies on the dollar from those who were forced to sell in a panic. This is the pivot from fear to empowerment. The coming reset isn't an end, but a transition. It will be a transition from those holding paper assets, stocks, bonds, and cash in a devaluing currency, to those who hold real, tangible assets. The rules of the game are about to change dramatically, but you now have the playbook. You understand the 4-stage cycle. You see the triggers that are activating. This knowledge gives you an incredible advantage. While most people will be caught completely off guard, reacting with fear and panic, you have the chance to position yourself for the greatest financial opportunity of our lifetime. The key is not just to survive, but to win. Your protection blueprint. So how do you shield your assets and get ready to capitalize on this historic reset? As a financial analyst, this is the blueprint I'm giving my own clients. It's a data-backed plan focused on preserving your capital first and seeking opportunistic growth second. First, you must build a cash fortress. In a crisis, cash is king. It gives you options and stops you from becoming a forced seller of your other assets at the absolute bottom of the market. You need 3 to 6 months of living expenses liquid and easy to access. Put this in high-yield savings accounts or short-term CDs. Remember, FDIC insurance protects you up to $250,000 per depositor per bank. For anything above that, U.S. Treasury bills are the safest place on the planet. Second, you must attack your high-interest and variable-rate debt. In a deleveraging crisis, debt is an anchor that will pull you under. Use the avalanche method. Pay off your highest interest rate debts first, as aggressively as you can. Try to consolidate any variable rate loans into fixed rate ones while you still can. Freeing up your cash flow now is absolutely critical. Third, diversify into hard assets. This is the most important step. When paper assets are being torched, you have to own what's real. This means allocating 10 to 20% of your portfolio to physical gold and silver. They are the only forms of money that have survived every single financial crisis in history. They protected wealth during the Weimar hyperinflation and during Japan's collapse. Beyond precious metals, look at stocks of companies with low debt, strong cash flow, and products people need no matter what. Think consumer staples and energy. And consider commodities, the raw materials our world is built from. Ditch the overvalued bubble stocks and long-term bonds. Fourth, if you have significant assets, you need advanced protection. This could mean using legal structures like revocable living trusts to shield your assets from creditors and legal battles. For maximum protection, some people even consider offshore trusts. Also, layer your insurance. Make sure you have robust health, disability, auto, and home coverage. These are your financial firewalls. Fifth, and finally, create a detailed budget and a risk plan. Know exactly where every dollar is going and cut all non-essential spending. Look for ways to create multiple streams of income, even a small side hustle, to build resilience. Your number one financial goal right now should be building that emergency cash fund. Only after that is secure should you even think about investing. The pattern is locked in. The triggers are firing. The signs of a major financial reset in 2026 are all around us. This report isn't a guess. It's your guide to a storm that has been brewing for 50 years. But unlike the unprepared masses who will be wiped out, you now have the knowledge and the blueprint to be on the right side of this great wealth transfer. Crashes don't destroy wealth. They redistribute it from the impatient and the uninformed to the prepared and the patient. You now have the chance to be one of the prepared. The choice is yours. To stay ahead of these rapidly developing triggers and get ongoing analysis to navigate this crisis, make sure you subscribe to this channel and turn on notifications. The information we share in the coming months will be critical. Prepare now.